Welcome to Conversations with Frank Fabozzi. I'm Frank Fabozzi. My guest today is Alicia Vidler, who's a senior markets practitioner and, as you'll see, an AI trailblazer. She co-founded Castilian Capital, which is a London-based hedge fund whose machine learning long-short equity program beat the market while muting correlation risk. She's an active researcher, finishing a PhD at the University of New South Wales on agentic intelligence and financial markets. We'll get back to agentic intelligence in a little while. She sits on the Journal of Financial Data Science Board and pushes for responsible, explainable AI in capital markets. She serves on the Global Council of 100 Women in Finance and chairs its FinTech initiative. Today, she's here to demystify how intelligent agents, large language models, and market microstructure research are converging and what that means for risk regulation and the next generation of alpha. Okay, welcome, Alicia.
Thank you. Thank you for having me.
Okay. You started out trading equity derivatives at Deutsche Bank in Sydney and later ran a macro book at Merrill Lynch through the global financial crisis. Which lessons from those early trading floors still guide how you model market microstructure in your AI research today?
Right. Thank you. It's a great question. So, as you pointed out, I actually have traded markets on both the equity, fixed income, and the bond side of the world. So it's a little unusual, but my background covers sort of many areas of finance. A lot of people only ever get to see one area, and there's a couple of key takeaways that still really, really, really resonate with me. And the first one is people make markets. People make the markets. Even when computers are trading the markets, and we can get into that a bit later as to how that looks, the markets don't follow the laws of gravity. You and I will both know that there are plenty of people who are in the financial markets with a strong hard sciences, engineering, physics background, and there's often a belief that there must be some laws of gravity that apply to markets, such as interest rates can never be below zero and the such and the like. And over time and through lots of experience, my first crisis was in 2000 when I first started trading. So I've seen quite a few in quite a few different places. Um, we see that markets follow their own patterns, and there really aren't these overarching rules and laws that can bind and hold together models. So humans have their strengths. That's the other key thing. Humans can be incredibly adaptable, but so do computers. And I learned very early on that I see them as two sides of the same coin. And it's really important to use the strengths and benefits of both.
Really? Well, after co-founding Castilian Capital, which I mentioned before as a machine learning equity long-short hedge fund, what proved hardest about moving an AI model from backtest to live portfolio? And what do most academic papers, which I'm sure you've read a lot of academic papers on how AI, what I find is academics tend to prove that they've found the secret sauce in outperforming markets, while practitioners tend to be much more low-keyed on this. But what do most academic papers overlook about that leap from backtest to live portfolios?
Yeah, it's a great question. Assumptions, basically. It boils down to assumptions. I think there's a phrase often used in the military, something along the lines of no battle plan survives contact with the enemy. My analogy for markets is no model survives contact with the markets unchanged. And it's not just slippage. Slippage is something that many of your viewers will probably be very comfortable understanding, that when you put a market order in, it may not actually execute at the price you saw the second you put the order in. But when you go to take an AI model, and the more complicated, the more this happens, there's usually a whole host of assumptions that you have to necessarily build and assume in order to build something that can sometimes hold, or not hold at all when you implement. And so it's not uncommon to see returns of theoretical backtest models reduce 20, 40, 60, 80% when they actually engage in the market. The other thing, and this is a little more subtle, and as you said, I do read a lot of academic papers. I have the pleasure of peer reviewing many of them and writing and co-authoring quite a few also. Academics often focus on a particular key aspect of a model that they're curious about. It might be volatility in a vol-based model for options. It might be reinforcement learning algorithms within a reinforcement model. But when it comes to trading, traders care about risk, they care about P&L, they care about fluctuations in volatility of profit and loss. And often those things are just at odds with how the model has been built in the world of academia.
Well, thank you for that analogy with the military. I'm going to have to ask you to text me, to email that. I do volunteer work with the U.S. Military Academy at West Point, and every time I do my notes for them, I always do an analogy between the military strategy and investment strategy. I never heard that one before. I'll use that next. Okay. Your PhD focuses on agentic intelligence for capital markets. In plain English, okay, how would you explain an agentic AI trader to a CIO who knows only about, let's say, a limited amount of large language models?
Certainly. I'm going to use another analogy. If we're good with the world of analogies,
You
I
could use
love
them all. Just you gotta email them to me so I don't have to review the video.
I love using analogies because it helps cut through a lot of the technical terminology in this field. Agentic models are models that have some inherent amount of agency. And agency really means the ability to understand and sense an environment and then actuate something, to do something with it. Now, that's a pretty broad definition and it's still being largely defined. But when I think of capital markets, I think of that as meaning having some piece of technology that can make an informed decision, which is more than rules based. And here's my analogy. Um, Many people will have children and often will try and send them on an errand. And a really good example is like saying to an average teenager, you can think of this as a risk budget, you can think of this as $20, go down to the shops, we're running out of milk, buy milk, come back, bring me the change. That's a rules-based engine. It's very similar to a lot of trading engines these days. Go target X, in place Y, here are your parameters, $20, bring back the change, give me my reporting, etc. I don't think of that as agentic. Some people might make the argument that's a bit like an agent. You dispatch them to do something. Another version is to say to your teenager, here's my credit card, check what we're missing in the fridge. Don't go crazy, be back in an hour. Now, those two analogies show a breadth of autonomy or agency. The first one is quite rules based, quite specific, if then else. And when you actually look at the second analogy, you're dealing with a far more set of broader parameters. It's also far more potentially robust to changes. What if the first shop at the end of the road is closed? What if the trading venue is not closed? It has a whole degree of choices embedded and freedoms and agency embedded in that choice. Now, chatbots are a really good example of this. A common chatbot really follows scripts, even when they're using large language models. They follow scripts. If a person chats in, I'm unhappy with my report, send me a new report, chatbot says, sure, I can generate a report. Some human at some point has told that chatbot how to respond. Agentic methods of chatbots are still in their early infancy, and there's been some really interesting developments. We can talk about this later in the last sort of 5 or 6 weeks with things like ACP, MCP, and agent to agent that have come out that help with some of the engineering aspects. But chatbots really don't solve a problem like someone chatting into your financial wealth management chatbot saying, I don't like my performance, switch me to something better. Chatbots really can't go and switch them at this point in time for lots of legal and technical and also just design reasons. That example of switching somebody or letting a teenager just decide what's missing with a credit card with no limit, that's agentic. And it comes with a whole host of benefits and problems. And at the heart of it is transparency, it's trust, it's repeatability and reliability.
Mm, okay, thank you. Now you said yeah, well, I've checked your CV. You've written a lot of papers. In 2024, you wrote a paper on multi-agent simulation of Australia's OPEC OTC bond market. Not like other bond markets are no OPEC also. Um, What real world behavior did the agents replicate well, and where did they miss?
Yeah. So thank you. I found it a really intriguing use case. Um, as you will undoubtedly know, and many of your listeners, bond markets have grown in size and importance after 2008 with increased issuance and after COVID. And they remain over the counter, OTC, bilateral, generally, in the Australian case, even trader to trader, person to person. It may be disintermediated by a computer, it might not be. And there's not a lot of technology or quant finance toolkit methodologies. You can't really take a Black-Scholes model and model the bond market's behavior. I'm not talking about bond options, but you can't take a lot of the quant models we've used for decades and really understand well and transport that to the market microstructure. And yet, these markets are hugely systemically important. Every time someone's pension gets paid in Australia or Canada or Britain or America, at some point, some bond investor called a pension fund has had to go and sell a bond. And they've had to enter the market to do that through the OTC mechanism. So the markets are hugely important and they're generally really concentrated. Australia, I believe, has something less than 20 regulated dealers and four key ones. The United Kingdom is similarly less than 20. The US is obviously more, but not that many more, actually. And so you have larger and larger volumes going through a handful of agents, real actual agents, both in the legal sense and the technical sense. And I wanted to try and find a way to model that behavior and understand that dynamics. I found it fascinating. And what was really intriguing was there is a handful of assumptions that people outside the market tend to make about those markets. Like, well, to make the market better, and I get what better means, but to make the market better, you just need more banks, you need more market makers, you need more agents. And that's not actually the case. You need more diverse agents. Another good example of something that was quite intriguing is this idea that if you have too much regulation, you can actually make the market far more brittle. And this is something we've seen in the US Treasury markets. It's something we've seen in the British Treasury, British gilt markets over the last couple of years. And so these weren't particularly surprises. My running joke with my trading friends was, please act surprised when I prove these things in a paper. But to the academic world and to the regulatory world and the agent-based modeling world, these were some really intriguing features. But what was fascinating is, as ever, what's hard to model. And what's hard to model is the underlying motivation of these agents. These are replicating real humans with real trading books. And as ever, understanding what drives a human to make a decision to trade or not to trade is actually far more complicated than pure rationality or utility.
Well, let me, the autonomous AI agents are being hyped as the next edge. Okay. Where do you see agentic systems adding alpha, let's say in the fixed income markets? And where is the hype outrunning reality?
Excellent. So there is undoubtedly a lot of tech debt, old tech, I mean, decades old tech sitting in some of the larger technology firms. And there's a lot of things that agentic methods or approaches or agent-based models can do to speed things up, from reporting through to analyzing bond information, through to analyzing flow very quickly. I think of those as low-hanging fruit and sort of, cheap engineering methods. And there's a lot of fintechs that are tackling that. In fact, there's a raft of fintech firms tackling that. But real alpha, I think, is going to come from a few particular places. It will come from being able to see new angles because agentic methods will be able to look at things differently. You can build an agent-based model much like, and I do build them, much like a portfolio management team with the decision-making processes. What is really still very, very important when you think about the alpha is understanding where profit can be made within a market. Is it understanding flow quicker? Is it understanding the impact function better? And every bond market is a bit different in that regard.
Yeah. Before, when you build these models, before an AI model can send an order, what governance and human in the loop safeguards do you insist on? limits, kill switches, model card audits, something else?
So this advice of mine is hard won from bitter past experience. You always need a kill switch. I have been a market maker on a system many years ago that didn't have a kill switch. And we know from anyone who remembers Knight Capital Group or even long-term capital, models are not perfect. Technology is not perfect, and the road to hell is paved with good intentions. You can very easily build a technology piece or technological piece of trading system that can be risk reducing and actually cause market negative impacts. And that's precisely what happened with the flash crash back in 2010. And so human in the loop, I think, is the best in class method at the moment. However, humans are fallible. One of the great problems when you have a human engaging with a computer, and there's a lot of literature in human computer interaction science around this, is humans are really bad at knowing when a computer is doing the right thing and losing money, and when a computer is doing the wrong thing and needs to be switched off, even when it's making money or losing money. CTA trading firms are notorious for saying this is one of their edges. They don't let humans turn off the computer because just at the point that the humans want to turn off the computer, it's when the CTA starts to make money. And there's a huge amount of evidence for that. So everything else you mentioned, the kill switches, the limits, good testing, separate test environments, regression testing, I think of those as hygiene factors. They won't necessarily save you, but you will have more problems if you don't have them. Human in the loop is still, the best in class method, but then there is this issue of making sure your humans are well enough trained to understand what's going on and when to pull the switch.
How many describe your company? How many individuals, staff, and what are their jobs?
So I,
Backgrounds?
so I actually at the moment am a full-time academic. I have just completed my PhD. So my role.
Congratulations.
Thank you very much. Literally within the last couple of days. So I actually focus on helping other firms at the moment deal with some of their technological issues and fix the various aspects of the trading, the algorithmic decision making, the idea of what needs to be fixed. And that's one of the biggest and hardest challenges, I think, for a lot of firms and a lot of financial firms is understanding what they want to buy in. Do they want to be a technology company? I mean, JP Morgan, for example, is on record. It's spending, I think, 18 billion on tech. Or do they want to be a consumer and do they want to focus on distribution? And that's also one of the aspects of where humans want to set up and step in. And what do you want to have that's commoditized, and what do you want to build that's your own within your own financial firm as a differentiator? And that's where I get involved. My team get involved at this point.
Yeah, I mean that's an interesting area. We have someone, and I think it was in the Journal of Financial Data Science, which calls himself uh, a pragmatic, meaning a practitioner and an academic. And that I find that is an interesting area. You know my son. You've done a podcast with him. I think that's sort of the area he falls into. But where are you teaching now? Is at the University of New South Wales?
No, I have actually had no teaching obligations, but I am a lead researcher on a autonomous swarm drone project, actually at one of the local universities here. And the most interesting thing about swarms and autonomous swarms is they share so many similarities to financial markets because an autonomous swarm has to make its own decision. It has to engage and trade. Often it has to collect and forage. Um, and the autonomous agents aren't allowed to collude. They're not allowed to talk to each other, and they're fundamentally decentralized. There's no, God in the system telling them where to go or where to fly, much like a financial market. And there's a huge amount of work in that particular field, in the soil field, over how do you learn how to behave in those market environments. And that's something that's actually been missing, I think, from the world of finance. How do you reinforcement learn or Q learning? How do you learn how to adapt to the market environment? And swarm researchers have been doing this for about 30 years, and it's fascinating and a really interesting space where I'm currently focusing a lot of my academic work on.
when you're reviewing papers that are sent to you blind, meaning the author's not identified, can you read a paper and tell right away whether it's done by a practitioner or an academic?
Yeah, yeah, absolutely, absolutely.
What are the hints?
So there's usually three hints. The first thing is that the world of academia and academic conferences in particular don't tend to cope with interdisciplinary research subjects. So they tend to be either I'm a computing science journal, I care about this from a computing science angle, or I'm a quant research journal, I care about this from a quantitative finance perspective. And so practitioners naturally will talk about the maths and the science and also how useful it is to basically reduce risk or to profit, to etc. And that's something that academics generally don't include. It's actually quite hard, I think, for a lot of academics to do that. Number two, most academics will make a lot of assumptions in a very short amount of space, and they will not be the focus of more than a couple of lines. It will be something like, we assume everything is normally distributed, and therefore equation 9 turns into equation 10. Whereas within the world of finance, we understand those assumptions turn into engineering practices, which turn into code, which turn into models that don't work. So we can spend 4 or 5 paragraphs just trying to think about what is our justifiable distributional assumption and then query it. I wonder how we can actually parameterize it. And the final one is, what is the takeaway? Undoubtedly, practitioners are focused on things like, well, I tested this on this hardware and it worked, and the model took less than 25 minutes to run. That's a very swarms also do that. They care about memory management. They care about, can I actually perform the model that I'm talking about? Academics will tend to focus on a broader generalizable concept or idea that can be used in multiple places. And those are the three key things I tend to notice in the different papers.
Yeah. What I've observed from papers that are submitted to the journals that I edit is that um, practitioners, well, academics tend to find uh, models that do well and outperform. I find that practitioners, on the other hand, show you how to use models and explain how they can be applied, but they don't make these bold statements about that they found such a. First of all, if you found something really good, you should never tell it. But yeah, that has been my observation.
That's a good one. I'll add that one as the fourth one. That's a good one. I agree. Totally agree with you.
Let's return to something you've said before, because dealing with regulation.
Mhm.
Regulators from the Australian Securities and Investment Commission to the European Securities and Market Authority, they're drafting AI rules for finance. Which proposals strike the right balance between innovation and safety, and which could academically stifle progress, or, in your words, make this brittle and possibly break?
So I'm not going to single out any regulator. And there are also regulators in Dubai looking at this. There's actually several Federal Reserves in the US that are looking at this, especially even just for bond markets. So I'm not going to single anyone out, but another analogy is the road to hell. The road to hell is paved with good intentions. Unfortunately, I believe in a framework for regulation. But unfortunately, a lot of these regulators are dealing with markets that have very old technology. If we look at the Australian markets, if we look at the Canadian markets, we look at the UK markets, we look at even some of the US markets, there is no central clearing for bonds still. And central clearing is one of those very boring topics that, equity markets have solved 90, 100, 150 years ago, depending on when the clearinghouses were set up. And it's really a fundamental component. So when you start putting regulation on a highly technical environment, which is missing some key componentry, it's really hard to make those rules and regulations robust and easy to implement in a way that's transparent. Without central clearing, think about what that does. It means it's really hard to know what was the volume. at a point in time? How do you trace a trade? All of these things are technologically difficult for a lot of these markets. Not impossible. There are methods and solutions. So some of these regulations are trying to pile on top of the structure that needs some fundamental underpinning going into it, I believe. And they've also called for the Australian government regulator in particular has done a lot of work trying to get the bond market, the local Australian bond market, to improve its underlying central clearing and set up a central clearer without the government's involvement, actually. But to my knowledge, as of 2-3 months ago, it's still not in the works.
Okay, that's interesting. You've spoken about, I'm going to try to pronounce this now because it's been many years since my bar mitzvah. Tikkun olam, that's a Hebrew phrase meaning repairing the world. So you've spoken a lot about that and AI for societal good. Okay, so not only are you involved, basically you're moving into the area of ESG. Can you share a concrete example or examples where market-focused AI delivered measurable societal or environmental impact?
Yeah, certainly. So thank you. Yeah, it's a subject very close to my heart, and as you rightly put, it's a belief that you just can't walk past the schisms in the world. It's not your job to fix all of them, but nor can you ignore everyone that you walk past. And I think technology and AI has immeasurable ways of improving this, and we're seeing this all over the world, but particularly to markets, and particularly to market-focused AI. The first one is there is being an incredible democratization of data and access to financial markets. If you're one of, like many of the listeners, and I'm sure I can definitely speak for myself in this regard, I believe markets work and I believe markets are really good things, all in all. And we have seen over the last 5-10 years with a variety of apps and a variety of firms that shall, everyone will know them when I mention, when we're talking about this topic, who have democratized the access for retail investors to buy and sell in a way in which that 10 years ago used to cost firms that I ran hundreds of thousands, if not millions of dollars to put that technology in place for us. So the democratization and access to financial markets, I'm talking equity markets even, has been, I think, an incredible opening up. And we've seen that with a massive explosion of retail investment coming back into the market. The other one, unusually, and this is something that isn't that obvious within the actual capital markets, is private credit. Private credit, for those of you, people who are listening, who don't know what that is, it's something that technology and capital providers stepped into, especially after 2008, and especially after the Basel Accords tightened the amount of capital required for banks to lend to small, medium enterprises. And by small, we're talking about the local coffee shop all the way up to a firm employing, 300 fitters and turners in a local manufacturing plant. And private credit firms set up with very little technology overhead. And many, many, many of them set up platforms where they could easily and quickly evaluate companies. They could evaluate their balance sheets. They could do trade financing. And this has been absolutely powered by much, much more accessible, cheap, robust, and in some cases, virtually free technology that has allowed private credit to fund the businesses that, without private credit stepping in, the banks and the financial firms of this world weren't going to be able to support and help grow.
Yeah. Okay. Well, uh, um, talent at the AI finance intersections is scarce. Which skills should tomorrow's portfolio managers cultivate if they want to build or supervise agent-based trading systems?
So I get asked this a lot, actually. And it's something I've spent a long time thinking about. And my answer would have been different 2 or 3 years ago before large language models came out. And as anyone who has seen a large language model, let alone coded with one, knows, they just gave us all this massive step up with programming skills. So, a number of years ago, I would have said Python or C++, learn to code. Actually, I've revised my views on this one. I think programming is a hygiene factor. You need to understand how computers fundamentally work, how code goes together. But when it comes to multi-agent systems in particular, the first thing people realize when they start engaging is this is not like a bond pricing model. You can't just take vol or interest rates or interest rate curve and shock it and move it and see how the model behaves and say, hey, if I move X, I get Y, I understand the model. Or if I move X and Y and Z in all together, I get a different number and I understand the model. That's the way, I have run model validation teams in my time. I have built models, I've validated them, I've proofed them, etc. That was just very standard toolkit stuff that we use in finance to understand how things work. Multi-agent systems are more like an orchestra. They're more like a variety of musical instruments all coming together and all moving together. And there are far too many pieces in those systems. You cannot actually bump and test each one individually. I'll give you a good example. The model we talked about, the Australian market, you have to set a number of agents. I could set it to 4, I could set it to 20, I could set it to 100. And I can test the behavior of the model at all those levels. And I can set it to every number in between. But every time I do that, there's a whole host of other parameters that have to get changed. So the mere attempt to use our old ways of testing models on multi-agent systems produces literally years worth of calculation engine work that you could sit waiting for. So that doesn't work. So what does work is it's a lot like learning a musical instrument. It's practice and it's patience and it's investing time and understanding how these complex products, these multi-agent, multi-component systems fit together. And that's really the skill set, the patience and investing the time to learn and watch and engage with these systems to understand how they fit together. I think that really is one of the key skill sets. Obviously, programming, sadly, unfortunately, for those of us who don't like to program, still important, but it's not the only thing anymore.
Yeah, I agree with you on that. I mean, if you were to leave academia, start your own firm full time, build a staff, you'll obviously want some experienced people and traders. What would you look for in rookies? People just out of school, and you were interviewing a few for various being understudies to the experienced people. What would you look for beyond?
I
I'm sorry. Go ahead.
no, absolutely. I would look for uh, curiosity. I would look for diligence, and I would look for their ability to problem solve. Large language models have allowed us to ask complex technical questions and get an answer, but you still need to know the question to ask. And you still need to know whether the answer is vaguely in the right direction, and you still need to know how to check the answer. I would look for curiosity because financial markets, and I go back to my earlier point, there are no laws of physics. There are no Newtonian laws of physics in financial markets. Interest rates can be negative. If we go back to 2006 or 7, I think if you polled, 99% of the world of finance, they said that could never happen. No, they just hadn't happened in living memory. It can happen. You can have negative rates. You can have negative fees. You can have a whole host of things. When certain markets I traded suddenly introduced options, people thought that the volatility in their Black-Scholes model couldn't go above 100%. Now, anyone who's actually ever read the Black-Scholes model understands that the volatility is a daily number. And whilst the daily number really can't go above 100% just because of the way a day works, what they were talking about was the annualized number. And that's a very, very, very different thing. So I bought a lot of vol contracts at 100% and it went up to 180 annualized. And so the idea of being questioning, of understanding that finance is not a closed system and it hasn't solved every problem. And therefore, you have to have a little bit of humility, be a little bit curious, but you do also have to be rigorous. And that's one of the things that I think is hardest to find in rookies. And it's this idea of, and you often see this with rookies who are really good at programming. They look at a problem and go, oh, I'll just change the code quickly. Done. You go, that's great. but what mathematical assumptions have you just broken, written, done, etc.? And just because you can program really quickly, vibe coding or otherwise, which is a whole other topic, but just because you can program really quickly doesn't mean that you shouldn't give it a bit of thought. And that goes back to my earlier point of patience, skill, practice. Boring, I know, but they do get you there in the long run, I believe. And that's what I'd be looking for.
Last question, two-parter. Looking ahead 5 years. First, make one bold prediction about AI in capital markets. Second part, name the single metric you'll watch to judge whether or not you're right.
Okay. 5 years from now, I think human traders are going to actually have to justify why they didn't use a machine to make a trade. They're going to have to actually explain why they chose not to. I also think that financial firms will have very clearly decided whether they're in the business of building tech or consuming tech and worrying about distribution. And that goes back to my earlier point, JP Morgan spending 18 billion a year on technology at a tech firm. And other firms, we saw this with risk engines, we saw this with a whole variety of technology over the last 30 years. Smaller firms, regional firms, other companies have basically decided they want to focus on servicing a client and distribution, and they just buy in tech. So you're going to see the world bifurcate into those people that actually own, build, and develop, which is very expensive, and those that use the GPTs, the Claudes, etc., of this world that gets them 90% of the way there, and they worry about the client relationships. In terms of the one metric, I think it's going to come down to CapEx. I think it's going to come down to how much people spend, because anyone, and we haven't really chatted much about large language models, but to build one from scratch, really hard and expensive, truly from scratch. I'm not saying downloading Llama and then playing with it. That's not from scratch. I mean, to really build it from scratch, billions and billions of parameters, large amounts of investment. Just look at the value and the amount of money spent by OpenAI. But to use the end results is really quite inexpensive to train, to refine, is actually quite inexpensive. And so I think you're going to see that bifurcation between the people that become consumers of most of the tech and even, regional players, even smaller banks, even local banks still write a lot of their own code. They still have their own developers. I think that's going to go away. I think you're going to see large capex from the financial firms that are tech firms that also do finance. And then you're going to see the financial firms that have great client relationships who buy in their tech. And that's what I would look for.
Well, thank you for this interview. I appreciate it. I wish you good luck in both your academic career, and again, congratulations on earning a doctorate. Be and most importantly, hopefully, your work related to and you didn't tell me if I pronounced it correctly,
Tikkun
Tikkun
olam.
Olam.
Tikkun olam.
Hopefully,
Yeah.
hopefully you'll make the world a lot better and make yourself a lot of money along the way. But again, thank you very much and stay safe.
Thank you ever so much. It's been a great pleasure chatting with you today, and I very much enjoyed the opportunity. Thank you so much, Frank.